Welcome back to Witness Richness. It's your boy JCP, and I'm back with another video. I am super excited about this week's topic. We're talking about credit. Now listen, if you had watched any of my previous videos, which I highly recommend that you do, you would know that I strategically built and leveraged my credit to acquire income-producing assets. Credit is a major key to my success. That's why in today's video, we're talking about the metrics of credit, how it's scored, how to grow your credit lines, and how to strategically increase your credit score overall. You should always have that credit score prepped, pretty, and ready to be leveraged. Let's get right into it. So I'm back at the whiteboard. But before we go into depth and we dive in on everything I wrote up here, let's just talk about the mindset behind credit really quickly, okay? So credit. Your credit score is attached to your social security number. And whenever you go to a lender and you apply for a credit, the first thing they're gonna do is check your credit score. They wanna know your credit history. They wanna know if you can be trusted with money. They wanna know that if they let you borrow money, you'll pay them back plus their interest. So at the end of the day, these lenders aren't really here to help you. They're not really here to, work with you. They're really kind of here to monetize off you. They want to lend you credit in return for you to pay them interest on top of it. But before they lend you that credit, they want to make sure that you're good to go with that money. And they want to see payment history. They want to see on-time payments. They want to see that you're not thirsty looking for credit. They want to see that you're actually utilizing the credit the right way, which is why we have the credit scores. The benefit behind the credit score is there are metrics. There are metrics to what a good credit score consist of. So once you learn those metrics, you can actually find ways to strategically, make those metrics look good on paper. That way you can get approved for loans and you get approved for lines of credit and you get approved, right? So the basics of credit, again, it's your personal credit history. And the prettier it looks and the cleaner it looks, the more likely you are to be granted credit. So let's get into it. The credit score itself ranges from 300 to 850. 300 being terrible, 500 being terrible, 600 being okay, but ideally, you shouldn't have a problem getting approved for credit lines or getting approved for loans if your debt to income ratio is, in check and your credit score is 700 plus. You shouldn't have any problem getting certain lines of credit with 700 credit score. So 700 credit score is like the goal. 700 plus is money bags, all right? So let's get right into it. So 35% of how your credit is even measured or the score comes from the payment history. Now listen, there are some shortcuts that I'll tell you about, and there are some ways you can go about things to, again, strategically increase your score. But some of these methods may not work if you have an underwriter, if you have an underwriter looking in and they figure out this authorized user. So that's the first shortcut to the payment history is adding an authorized user. Now, if you're not familiar with authorized user, go ahead and look it up. Authorized users, piggybacks, or trade lines, it pretty much just means that you're sharing a credit account with another person who has a good credit score. So in a nutshell, an authorized user, let's say your grandfather has a credit card. He has a high limit on it, $10,000. He has a low balance on it, doesn't really use it that much. He had it 15 years. If your grandfather was to go ahead and add you as an authorized user on his account and actually keep the card for himself but just add you on, your credit profile will share all that positive history. But keep in mind, if he fumbles on that card, misses the payment, you'll also get that as well. But pretty much trade lines can be removed or added to any account. And they will help you significantly with payment history. But understand that it's not your actual history. It's from an authorized user, but it does help. Now listen, one more thing on authorized users. Authorized users doesn't really impact your credit score in the long term. What it really is a kickstart. It's a spark plug to open the door and build relationships with these creditors. So authorized users help with payment history. But at the end of the day, okay, if you look down here, what you really need in most cases to get approved for loans or mortgages, lines of credit, is you need to have 2 years of on-time payment history. So even if you have, bad credit now, whatever it may be, go get a secured line, go get a secured credit card, open one up, you put $300 down, and start using that card just so every single month you actually can start tracking a payment history. You want to have credit from a credit lender who reports to one of the 3 major credit bureaus every single month, that being TransUnion, Equifax, and Experian. So you want to make sure you have that payment history every single month on at least 2 counts. Start today. A shortcut is add an authorized user, but at the end of the day, you want to build your own history regardless, because when you go for underwriters, they will look at authorized users and discount all the bluff points you'll get. So start building your credit today. There's not really many ways around payment history besides making a starting right now, starting today, and actually using authorized user. So again, payment history consists of 35% of your actual credit score. So make sure you're making on-time payments. And if you don't have anything right now, go get a secured line and continue to make online payments, because every single month will eventually strengthen your overall credit, okay? Now, 30% of how your credit score is measured is credit utilization. And what that means is how much credit are you using? So let's say you have a limit of $1,000 on one credit card and you only have one credit card. You have a balance of $500. That means you're using 50%, half of the credit card. So your credit utilization will be 50%. Ideally, you want to have that credit utilization at 30%. If you have a credit card with a limit of $1,000, you don't want to use any more than $300 because you don't want to overutilize your credit. Now, the reason why I say 30% is because if you actually want to increase your credit lines, which you should be doing, you have to find out which one of your credit cards will give you a hard inquiry on your credit report if you apply for a credit limit increase. Or any credit card or any lender that does not give you a hard inquiry for applying for a credit limit increase, literally set it on your phone. Every 3 to 6 months, call that credit card company or get online and apply for a credit limit increase. You want to grow your lines. You want to have as large lines as possible. You don't have to use them, but have them prepped, pretty, and ready to be utilized. So strategically, every 3 to 6 months, go ahead and call those lenders and apply for credit limit increases. The way to get that done is to have your credit utilization between 20 and 30%. If you're not using the credit card at all and you have 100% available and you go ahead and apply for an increase, here's how lenders are gonna look at it. They're gonna think, well, we've given you a credit limit already. You haven't used it at all. Why are you applying for more credit? Why are you applying for an increase? And if you're only using 10% of it, they're gonna say, why are you applying for an increase when you're not even utilizing the credit we're giving you already? So make sure that you have your credit utilization between 20 and 30%. That's if you want to keep on increasing that credit line every 6 months. Now, if you want your credit just to look pretty, because you're getting ready to apply for some type of loan or some type of car or whatnot, then you can go ahead and crank your credit utilization down to 10% just so you can actually get that loan. But ideally, you want to keep it in between 20 and 30%. Now, also, if your credit utilization is high and you don't have the capital to pay it down, that's when you may want to wait 3 to 4 months, whatever it may be, and apply for a credit limit increase. Let's put numbers behind it. Let's say you have a credit card with a limit of $1,000 and you're using $500 right now. You're at a 50% utilization rate. That's not great. And you don't have the $200 or $300 to pay it down to get it to that $300 mark. That way it does reflect the 30%. What you would do is call the credit card company, assuming your payments are on time, and apply for a credit limit increase. Now let's say you go from $1,000 to $2,000. Now that same credit card still has a $500 balance on it, but the limit is now $2,000, which means your credit utilization has now dropped to 25% on that particular card. So when it comes to the credit utilization, you either pay down the balance or you increase the limit. But ideally, 30%, have it there so you can keep on getting those increases every 6 months, showing the credit card company that you're actually utilizing their credit. Or if you want your credit looking extra pretty, extra clean, then you bring down 10%. But anyway, you shouldn't have those credit cards no more than 30% if you want to have pretty, prep, clean credit, okay? Next is length of credit. Now again, I had talked about authorized users. That is another way that you can actually cheat this code here, because if you add an authorized user, or if you are an authorized user on somebody else's account and they have a 15-year, credit reporting history, if you're an authorized user, you'll get all that history. But again, that will only work for you for maybe some car loans, maybe some credit cards. If you have an underwriter looking at, your credit score and there's an authorized user there, that may not help you that much, but it'll get you in the door. Authorized users will help with the length of credit. But at the end of the day, that comes down to you never want to cut off your oldest account, no matter what it is. If you have a credit card from Macy's from 2008 and if you still have that card now, you never want to close your oldest accounts. As a matter of fact, if you close some of your newer accounts, it would actually increase that length of credit. So understand that. Always keep open your oldest account. And if you ever wanted to, shift your credit score just to make it jump up a little bit, you may want to consider closing your newest account, especially if it's not a high limit account. So length of credit history is 15%. Now, new credit. New credit is measured really on your credit score by the number of inquiries. I would tell you this: don't have any more than 2 or 3 inquiries on your credit report at a time. Inquiries fall off by themselves every 2 years. And there are ways you can dispute inquiries to get those removed as well if you have too many, but you don't want to have anything more than 2 or 3. In my experience, I've always had about 7 or 8 on my score, because it does only count up for 10%. But ideally, to have that pretty, prep, clean, ready to leverage credit, you don't want to have any more than 2 or 3 inquiries on your report. And you do want to make sure that you're not, if you have too many inquiries on your report, the lender will look at you as credit hungry, credit greedy, or they start asking themselves, why is this person shopping so much credit? What are they trying to do? Why are they so thirsty for credit? And if they start thinking like that, then that will reduce the chance of you getting approved for a loan. So keep the inquiries low. And again, they fall off by themselves every 2 years. And if you have any personal accounts that have inquiries that are actually yours, you don't want to remove those inquiries because they can close the account. But if you have business inquiries on your personal credit report, you can get those taken off without any problems, and accounts will remain open. Now, the last 10% that makes up your credit score and how this is ranged is the type of credit. Now listen, lenders like to see a mixture of types of credit, meaning they want to see maybe a car or 2, a mortgage or 2, credit card or 2, a loan or 2. Now, if you have one of all of these, then you would get the whole 10% of that score based off of having a car, a loan, some credit cards, and a mortgage. A mortgage usually strengthens your credit. Most lenders, when they pull your report and they see you've been approved for a mortgage, they're more likely to approve you for a credit card, or maybe a little personal loan or a little car loan, because you already have such a big line of credit that's ideally, right, being paid on time. Now, one more thing to talk about these types of credit, okay, is that credit cards, okay? Depending on the limit of your credit card will completely shift how strong your credit is. Now remember, you want to build your credit lines up. And sometimes it does take months or years because you're constantly, every 3 to 6 months, applying for credit limit increases. And some companies do give you hard inquiries when you apply for a credit limit increase, so it's not really worth it to keep on applying for them. So growing these lines can take a little bit more time, but having these credit card lines with large limits will overall increase your score. Let me share a little story with you of how I actually increased my credit lines fast. So at one point, I was applying for credit cards, and I grew most of my credit card lines between $1,500 and $5,000, but I couldn't crack $5,000 for almost a year. Every time I applied for a new credit line, I would get approved for like 3,500, and then I would, wait a couple of months, go for an increase. I could not crack over 5,000. So eventually, I had 2 credit cards with Chase. Okay, they were different, different actual cards, but Chase was the lender on both of those lines there. So what happened was I had one Chase account for $5,000. I had another Chase account for $6,000. So I called them, and one account I had open for like 6 months, and the other account was new. So after I got approved for the other account and it was opened, I actually called Chase and I said, listen, I want to know if I can close down this $6,000 credit card account and take that limit and add it to my previous credit card account. And they said yes. And then the $5,000 card was the older card. So what happened is I closed that account, which helped my length of credit because it was a new account. I closed that account down, and then I took that $6,000 limit and it was added to my previous account, which then took my credit card limit from $5,000 to $11,000. From that point on, every card that I applied for, minimum $10,000. Understand that. My largest line right now, I have one credit card that gave me a $20,000 limit. And I have several other credit cards in between 10 and 15. So this stuff and how I'm telling you to grow your credit lines, it actually works. All right? Now listen, once you get to the point where you understand, these metrics and ways to, manipulate, make them look pretty on paper, this is the pretty much core of what you want to be approved for different lines of credit, right? You want to have 2 years of on-time payment history. That's between all your accounts, okay? And you don't want to have any more than 2 or 3 inquiries at a time on your credit score, okay? And I call this the 2, right? You don't want to have any more than 20 to 30% credit utilization. Now, remember, this can always change month by month. If you have a high credit utilization in the beginning of the month, by the end of the month, if you pay it down, the next month over, your credit score will increase by a lot. So, you can always play with the utilization. Also, you want to have 2 major credit cards. And when I say major, that's like Discover, Chase, American Express, major credit card companies that report to the bureaus every single month. You want to have at least 2 of those accounts with $5,000 limits. That right there, that 2 effect, will give you a strong overall credit score. And with that being said, what here's in the red, because this is a channel where I talk about assets, right? So the red right here is if you want to get approved for a residential mortgage or even a small loan, these are some of the things you're going to need. 2 years of taxable income, 2 recent pay stubs, and 2 months of statements. That's proof of funds. If you have this in check, then you have this in check, and you mix that with a decent debt to income ratio, at least here in New England, this will get you qualified for a residential FHA mortgage all day if you fit these criteria. So you'll be able to leverage this to acquire income producing asset. So just to recap, in this week's video, we talked about the basics, the metrics of how credit is actually scored. We talked about ways to increase your credit lines, and also, once you do all these things, that's going to give you that score you want, that 700 plus. All right? Now listen, even if you're not sure of how to leverage your credit right now, that's fine. The first step is to go ahead and increase your credit score. And when you get a decent credit score, you want to go ahead and build those lines. Have that credit prepped and pretty and ready to be leveraged. And the moment you find your investment tool, your investment strategy, your credit's ready to go. And I know that you have to find value in this week's content because, listen, I use my credit to acquire income-producing assets, and I grew all my credit lines from not even getting approved to I have one card at $20,000. So what I'm preaching right now definitely works. Don't forget to like, share, comment, and subscribe. No, seriously. Like it, share it, comment, and make sure you subscribe. See you in next week's video.